The reverse repo market just hit a record high of $2.3 trillion, and it is helping to dry up liquidity in all asset classes. So this is something that we must address here on this channel to really bring you guys up to date what has been happening in the reverse repo market, as well as what is likely to happen in the month of July, because we have earnings estimates that are so high, we are setting ourselves up for failure in a massive way. But this could be a big opportunity, not only for some of our favorite stocks, but the overall market. So we are going to get into all of this key information. Hit the like button and subscribe to the channel. Thank you guys for doing that. If we can get this video to 200 likes, we will have Alex see how much of a video she can make by herself. I know you guys like to see Alex, and it was a great refresher for the community. Now let's dive into all of this key information. Thank you guys for tuning in again. And the reverse repo market sitting at $2.329 trillion, rewarding clients, which are usually banks, and specifically 108 different banks were a part of this reverse repo, about 1.55%. And that's a decent return given the NASDAQ is down almost 30%. We just had the worst first half to a year in the equity markets, aka the stock market, in the last 50 years. So we are going to play a video, not right now, but here in just a couple minutes, of an analyst talking about how this does affect the markets. But long story short, as you guys can see from the chart, when there is little risk in the markets, when the Fed is your friend, so on and so forth, you don't see really any money in the reverse repo markets. Even during the COVID crash, the reverse repo markets only hit about $207 billion at the peak. Now you're sitting at $2.329 trillion. It has been pretty much straight up on a very consistent basis, and this is drawing money from different asset classes and putting it into this reverse repo program. So it is a form of tightening, and it is hurting the markets in a very dramatic way. At the same time, you guys got to keep in mind, $2.3 trillion, it might not sound like too much money when you put it in context to an Apple that's worth $2 trillion, right? Some of these companies potentially that are worth over $1 trillion, give or take, at the time you guys are seeing this video. If you guys are seeing this way in the future, then maybe these companies are not worth $2 trillion still, or even $1 trillion. We'll see. It could get pretty crazy, and we're going to talk about it here in this video. But that is over 10% of the M2 money supply. All of the money, the US dollars in circulation that are anywhere, that is 10% of all the money in America. That is a very big deal, and that's why I want to address it here on this channel. It's not $1 trillion anymore. Remember when we were talking about the reverse repo market at $1 trillion? Well, it is over double that now. So you went from 5% of the money that is in circulation sitting in the reverse repo market to now over 10%. And that is a very big deal, something we should talk about here on the channel. Now, I will go ahead and play this video for you guys. It is about 1.5 minutes long, and then after that we're gonna talk about specifically what is to come in July and go over this article, which sums it up pretty well. It says S&P 500 earnings estimates may be too high, and the equity market may be setting itself up for disappointment this summer. So let's get to it. We will be back right after this video.
So I think that 3.5% is something definitely to keep in mind in terms of the Fed and what they need to do. You know, they have a lot of extra help that most people don't even know about. You know, today the big news that nobody talked about was that the reverse repo facility, that parking lot for all that money, reached $2.34 trillion. Big deal. What does that matter? Because you know what? That means the Fed tightened again. How? Everybody says, what do you mean the Fed tightened again? Where do you think most of the money in the money markets and most of the cash in the entire economy, the M1, 2, 3, you know where they're all going? They're all going in that parking lot. $2.34 trillion worth. That money used to be in margin accounts that were holding stock positions or in accounts holding treasury positions. But now, basically, it's a no duration, no credit risk. You get 155 basis points, and it's just drawing the money in. I think rates are going to suffer from the economy suffering, and the economy is suffering. And I fully suspect in 3.5 weeks, we're going to get a very low second quarter GDP. Will it be negative? I can't tell you, but Atlanta Fed now doesn't look all that terrific. And finally, look at Boons. We could learn a lot from Boons. Boons on a quarter to date, well, they closed at 134 today. Less than 2 weeks ago, they were at 177. They closed the quarter at what, 55 basis points? I guess what I'm saying is Treasury yields have zoomed, as sovereign yields have zoomed, but now they're all starting to float back down. And that's the part we need to pay the closest attention to. And truly, the Fed could talk as tough a game as they want. Inflation probably did peak, but that doesn't mean prices are going down. And that's going to be the new topic in about 9 months.
The equity markets may be setting itself up for disappointment this summer. Earnings trends for the S&P 500 have been rising despite growing concerns of a U.S. recession due to the Fed tightening cycle. This has created a strange divergence between the earnings trends in the S&P 500 and the NASDAQ 100. The variation could come as a warning that earnings estimates for the S&P 500 are too high and need to come down. Even odder is that many of the top companies in the S&P 500 like Apple, Microsoft, Amazon, and Facebook or Meta platforms has seen their earnings estimates for the calendar second quarter falling along with the entire year. On top of that, while we hear a lot about rising cost and inflation, analysts have yet to adjust their operating margin estimates for the S&P 500, which remain near historic highs. This could be setting the market up for a disappointing earnings season, bringing a fresh round of downgrades. Earnings estimates for the S&P 500 in 2022 have climbed to fresh highs, reaching $228.26 per share, while those for the NASDAQ 100 are trading near their lows. It seems like an odd combination considering the overlap between the two indexes and the number of large companies among the top holdings. And what he is saying right here, let's break this down in simplest form. He called out Apple, Microsoft, Google, Facebook. These are companies that make a lot of money, that have the highest weighting in the NASDAQ and the S&P. For an example, in the S&P 500, Apple is 7% of the weighting alone. Microsoft, another 5%. Facebook, another 2%. Amazon, another 6%. These companies control the S&P as well as the NASDAQ. So when S&P earnings continue to climb, NASDAQ earnings continue to fall, that's a very strange, like they said, strange divergence that you are seeing because they're almost 1 in 1, right? If Apple falls a lot, the markets are going to fall a lot. The S&P and the NASDAQ. For a quick example there, you could get into more nuances, but that is the long story short version of what he was saying. And when estimates are so high and then companies come in with really bad numbers, which, let's be honest, is going to happen, that's where you can get massive disappointments in the markets. And for companies specifically like Apple and the over $1 trillion companies that control both the S&P and the NASDAQ. Now, these earnings will be coming out towards the end of July, really from July 20th until the end of July. That's when you can expect to get all of these very large companies, again, which control the markets. Considering the markets and the S&P is sitting at levels that are just not good. $377 on the S&P. That is a total decline so far of over 21% for the first half of 2022. If you get some really disappointing numbers and the markets are already expecting really good numbers, you could be in for substantial downside, even considering we're down 21%. The NASDAQ is down almost 30% for, Q1 and Q2 of 2022. So that is setting us up for a real disaster. But keep in mind that timeline from really July 20th until the end of July, really the second half of August, is going to be very eventful because we have the Fed that will be raising interest rates. It's expected about 50 basis points July 27th. And then the day after that, we get advanced numbers for Q2 GDP, which the advanced estimates, just to be clear here, they're not the final numbers, but the first advanced estimate we got for Q1 GDP data or GDP data was a negative 1.1% print. And then every revision after that, it continued to go down until we just recently got the last number, the final number for Q1 GDP, which was negative 1.6%. So it can move around a lot, but if we get, say, a negative 0.5% print, negative 1% print, it will not be revised to be positive, and we will then be in a technical recession. And then the market dynamic is going to change a lot, because if we are in a technical recession, when the Fed is raising rates, as there is quantitative tightening, as we are at over 8% year over year inflation, and obviously inflation is much higher than that. Have you been to a Walmart? Have you been out grocery shopping? Have you filled up your gas tank? Have you tried to get a new lease agreement? Everything is a lot higher, but that's the data that we know, and we know the markets are not going to like that. Mix that with earnings estimates that are coming in well under the expected number. Not going to be good. Let's just say that. Not going to be good. That's probably when you flush out to the downside, and that is probably when you get the bottom for 2022. And then we can probably start to make a move to the upside. As soon as we go into that technical recession, you will see the bond rates fall, and that is going to be a, positive thing for the markets in the short term. It will create, a more friendly environment for borrowing money, as most recessions do, and as you do tend to get deflation during recessions. That will be good for cost of capital, for inflationary pressures. But then again, people are going to say, hey, how long is a recession going to last? How deep is this recession going to last? Because we've never seen a recession with, less than 4% unemployment. So something is going to break in a big way, and it's probably going to be the stock market and equity markets for a decent amount of time. We know yesterday we got the PCE price index, and that did come out at about 6.3%, which was the same as what we got for last month for what we got in April, and that is not such a great thing. We were expecting this to actually come in at 6.4%, so a slight uptick. We did not see that new all-time high for 2022, but we did not see that number come down in a big way. So here in just a few short minutes, we will also get, check this out, ISM manufacturing PMI, and that's going to be very important for markets. That's the producer side of inflation, and that is what is going to control really the markets throughout the rest of the trading day today. Now, the margin debt, this is something I am personally very concerned about when we're talking about this scenario that could play out really from July 20th until mid-August with this just bad market string of catalysts. Let's just call it that. It's not one thing, it's like 5 different catalysts that are not going to be good. At the same time, we're going to get inflation rates that come out earlier in July, and that could also set a really bad tone for the markets. Just considering some things like rental prices likely to continue to trend higher, some other things as well, it might not be so good. Now, the margin debt has only went down about 15%. I've talked about this before, but I think it is very helpful to point out again here in this video. We've only went down about 15%. The NASDAQ down over 30%. That means margin is really gaining in people's portfolios because you have not seen enough margin actually being covered and reduced, and the portfolio values are going down in a big way. So I think all of this is pretty concerning here for the downside over the next month or two. We'll just call it next month or two. But I do think you will find a great buying opportunity, and I do think you will find a bottom out of all of that mess. And that's where hopefully you have been buying the dip throughout the last couple of months, throughout the 6 months of 2022, almost 7 months so far of 2022. And you can take advantage of that slow and steady uptrend back to the upside. Now, specifically for AMC stock, we do have very high short interest still. We do know this is what we have waited for, right? I've been talking about this for the last 6 months. You want the markets to come down. You want cost of capital to become more expensive, but you need a catalyst for AMC stock. You need something like a new stake in the company. You need something along the lines of the popcorn business is getting up and running, the credit card business getting up and running, more expansions with crypto, new partnerships, whatever it is. You need to see some degree of a catalyst to force people to start covering, to get the stock price to go up. In this extreme fear market environment, you are not going to see AMC just rally for no reason, even though Q2 portfolio rebalancing has looked to be a good thing, and we are above the 50-day moving average, which is also a positive thing. Mix on top of that, you got a lot of calls for that July 15th expiration. A lot of things look good right now, but you still need that underlying catalyst. So that's kind of what I expect here in a nutshell over the next month or two. That's really what is going on in the reverse repo markets that you guys needed to know about, and my quick perspective on how AMC fits into this whole equation. So that is going to be all for this video. Hit the like button and subscribe to the channel if you guys found value out of it. Like I said, get this video to 200 likes. We will have Alex back here in another video. Yes, that will be today as well. So just stay tuned for that if you guys do hit the like button. Thank you guys for tuning in. Get your free stock down below in the description of this video with Webull, Moomoo, and Public. And if you guys want to trade with me live in real time, link down below in the pinned comment. Thank you for watching, and I will see you in the next